Hi there, and welcome to another edition of TokStocks. I'm your host, Keir Reynolds, and today we're lucky enough to have Sean Black, now CEO of Happy Belly Food Group, back with us for a quarterly update. It's been a few months since we last caught up with him. Hey, Sean, how you doing?
Great, Keir. Thanks for having me. Good to see you.
Hey, yeah. I hope you've had a nice summer, and we're into the first week of September here. Boy, time flies fast. So look forward to catching up. And I've been following some of your updates on Twitter. You're pretty good at keeping us all sort of updated. It looks like you've gotten yourself quite a few frequent flyer miles and put some miles on the car. So lots going on. Look forward to unpacking a bit of that with you.
Thank you.
Before we get into all that, let's get our 60-second pitch out of the way. First question. What is the name and stock ticker of your company?
The name of the company is Happy Belly Food Group, HBFG on the Canadian side, and HBFGF on the US OTC side.
What is the vision for the company?
We look to be a leader in the emerging brand category of restaurants and CPG. So it's a leading consolidator of emerging brands is what we do in the food space.
How many shares are outstanding?
About 125 million total shares outstanding today.
Who are some of your major shareholders?
Well, our COO, formerly COO, his family is approximately about 20 million shares of the float are owned and controlled by them. We have a couple of strategics, one being Trio Capital, another one being K2, funded to Toronto. Some family offices. We believe a very significant portion of our float today is in very friendly hands, and probably a big reason, the amount of stability we've had in our share price this summer.
What is the insider ownership percentage, and how much capital have you invested?
That's a good one. When I joined, insider ownership was 2%. Today, we're about 24% insider ownership, with all insiders buying in the float. Every single person on our board and our management team has acquired their shares openly in the float. I'm approaching 3 million shares myself, outside of what my family and stuff owns that I've also purchased in the float.
Are you fully funded for the upcoming year?
Yes, we are. We are fully funded for 2024 and into well into 2025, depending on the opportunities that come up. But yes, fully funded. No bad, unbought financing coming anytime from us.
What are some of your short-term catalysts?
Short-term catalysts, disciplined growth. We are trying to be a trusted, disciplined growth company, both organic and inorganic. So the number one most meaningful catalyst that we can do is for the rest of 2024, in my opinion, is to continue to open restaurants. We have a significant pipeline of restaurants. Continue to, do what we're good at. Open them, operate them, and get them profitable.
And finally, what is your market cap today?
Today, we're about 60 million market cap.
Excellent. Hey, thanks very much for doing that. So it's been about just over 2 months since we last chatted. We kind of did a midway sort of mid-year sort of check. You've now had your Q2 sort of financials kind of come out, and those showed continued progress in the business. Before we sort of get in all that, maybe you could refresh those of my audience who have not seen or heard of Happy Belly before. Would you mind maybe just explaining a bit about your background, who you are, who your team is, what you've done before in the space?
Absolutely. My entry into the QSR space was as an employee working in high school. Opened my first restaurant when I was 19. Lucky enough to build that and exit that one a couple of years later, my hometown of Arnprior. Since then, partnered up with Alex and Mark Rikiki. I started off as a franchisee and then partnered with them. We launched a brand called Extreme Pita. We built that across Canada and globally into international markets. That was our first foray into QSR at scale on the franchise side. Second brand we built was Mucho Burrito, also at the time the leading fast casual Mexican player in Canada. We built those and sold them to MTY when we had about 320, 330 open. I think about another pipeline of 50, 60, 70 stores. We exited that in summer of 2013. Sold it to MTY. I joined MTY as their chief development officer. Helped Stanley in the time, put a plan and a vision in place and gave them their U.S. market entry, which was a huge boost to them and, a major driver in their market cap and growth opportunities. So good timing. Post my time at MTY, I rejoined Alex and Mark Rikiki. We launched a company called Crave It Restaurant Group. Within that group, two of the brands that we built and sold were Fresh Restaurants, Fresh Powered, which was the leading full-serve plant-based restaurant in Canada. And we also had Burgers Priest, which at the time was the leading growth brand for smash burgers in Canada. We built those. We partnered behind the scenes with Recipe and Fairfax, which is now owned by Fairfax. We grew those nationally across Canada. And in summer of 2021, we sold those two brands to Recipe, which is now Fairfax. So, long time in the business from, in the late 90s until today. Been a restaurant guy. And our team, if you look at our board, two board members are my former business partners, Mark and Alex Rikiki. We have a CPG veteran on the board, Kevin Cole, from formerly of Mars and Ferrero Rocher backgrounds. And then you also have Sean Moniz, which is the founding member of what we are today. So, we've got a good team on that side. On the management side, we've also brought in a gentleman named Gary Fung as our CFO. Gary was, head of finance for Tim Hortons, a major role, that he held here in Canada. He joined us full time in, I believe, April. He joined in January. VP of Finance, he assumed his role as CFO in April of 2024. So we've built a good team. We've definitely been putting the band back together with a lot of the team that we've worked with in the past. And we've got some really strong members that have disciplines in both CPG and QSR. And we're scaling them actively across North America.
Yeah, so one of the things that I found was really interesting a couple of years ago when you got on my radar screen was that, your team has unique expertise. You guys have really grown up and been serially successful in this sort of QSR space. And here you were, joining a company and you were going to go build it all. And we could be aligned with you. We could be shareholders and really aligned with you and have all the growth sort of ahead of us, whether that growth is going to take 5 years or 10 years. But we get a seat at the table to be your partner, so to speak, as a shareholder right from day one. I thought that was rather unique, not something that's typically found in the capital markets. Usually, these opportunities are reserved for private equity or very sophisticated high net worth investors. And by the time retail gets involved, it's usually through an overpriced IPO or something down the road. So thought very, very unique sort of opportunity. Maybe that's a good segue if you could just give us a bit of an overview on what Happy Belly is today versus what it was when we sort of first met. What do you have today?
Absolutely. And I think you touched on a very good point. Based on our previous track record and our exits in the business, I believe we could have went that route. We could have just, raised private equity and, built the business. But we saw a really unique opportunity, in my opinion, with what happened in the space. I believe with MTY having a very big focus today, with 60 to 70% of their revenue is U.S. derived. When I joined there, almost none of it was. And with Recipe being acquired and taken, basically private through, as a holdco of Fairfax, it created some significant open ice and, created an opportunity for us to, this time around, allow all of our shareholders, our area developers, our vending partners, our partners across the globe, to actually have a share in the equity. So this time we got to let everybody participate in the upside of the value that they add to the company. So if you look back right from the start, very unique opportunity, especially considering that the management team and the board, when we joined, we didn't take any free options. We didn't take any free stock. We had to earn them on the way up, and we had to kind of check for them, which was a big part of our plan at the start. We had a plan for when we joined to build this to $2 a share by summer of 26, and I think we're executing very well on our plan. Market will do what it wants with the share price short term, but long term, we've cleaned up the float. We've got a plan here where we now have the original goal was to get us to 10 brands, 10 QSR brands plus our CPG side. Give us scale, give us a house of brands that we could actively leverage in an emerging category across Canada. So that was the original footprint we were trying to get to. If people look back, it took MTY about 24 years to get to 9 brands. We are now 2 years and 3 months in, and we are at 8 brands. So I think we've done it pretty well at an accelerated pace. We're not there yet. We're not at 10 brands. As a floating average is probably what we'd like to hold over time. And in a diversified portfolio, if you look across Canada, we have something as far out as BC, where we have, in my opinion, one of the premier breakfast concepts in the country called Yolks. We have an Ontario-based, in my opinion, number one smash burger brand in the country called Rosie's. You can go right to our plant-based offerings where we have Heal, Wellness, and Let Us Love. So we have a very diversified portfolio today. It continues to get more diverse as we do deals. And that's the next phase for us, is to continue to consolidate in the categories and be a leader of emerging brands. So we're just getting started, but that's who we are. We're a platform today that partners with some founders. Some of them we buy out, but as soon as we acquire a brand, we look to accelerate that growth.
Hey, excellent. So let's talk financials a little bit. You had some financials come out last month. You're a bit early to report, which is always a good sign. One of the items that sort of stood out for me a little bit was sort of the QSR EBITDA. It rose about 33%, sort of Q2 2024 versus Q2 2023. So the growth is nice.
Yep.
Over the same period, your system sales within that category increased 432%.
Mm-hmm.
So I imagine that has something to do with the difference between a corporate-owned store and a franchise store.
That's correct.
But maybe you could kind of unpack a little bit of that for us and really talk about kind of the future of the business based upon those sort of financials.
Absolutely. That is correct, because when you look at year over year, the previous year we had, especially even in last year, we had more corporate store units. And as we open more of the franchise units, you're going to see the royalty piece scale. And actually, we expect the margins to increase significantly, because the royalty revenue, while it's not as high, and it shows in, so you see your system sales, but your royalty, your actually reported revenue, will become very high margin. And that is the number one piece of the business that we're actually after, is the royalty side of the business. So that will continue.
Right. So instead of owning and operating the restaurants, which typically are fairly low margin, you are able to sort of offset that risk to proven sort of franchisees. They're going to operate it, and then you get a flow of royalty. So your risk is, can they operate the business? If they can't, then then you look to find another franchisee, look to find other locations. You're not going to hit out of the park every time, but you haven't sunk your own capital in and lost millions of dollars on a location.
Yeah, we would expect to see margin improvement, and also CapEx come down significantly. So, because the CapEx, when you're doing the franchise model, the CapEx is borne by the franchisees. So our margins on our business, we anticipate as Q3, Q4, and into 2025 come around, our margins will improve significantly. And so margin expansion is something that Gary and the team certainly pay attention to. We have no issues where and when needed opening up corporate stores when the opportunity comes up. We evaluate them every single day. A great piece of real estate came up and we happen not to have a franchisee, then we will consider it for a corporate store. We have a few of them in front of us today we're considering. But we're very fortunate also that franchise demand for what we have today and the brands in our portfolio is high. So we're lucky that we have some very significant franchisees that have acquired stores and large blocks of stores. But yes, we would expect to see continued margin expansion and growth on the royalty sector of the business well into 2025.
And is that really the future of the business, really focusing a bit more on franchise locations rather than corporate-owned stores, because you could scale franchise a bit easier? Is that fair to say?
Yeah, if you look at a company, we use a comparable to in the U.S. You got Cava. It's all corporate. You had a company out there like Dutch Brothers, doing an incredible job as being an emerging brand in the coffee category. Only recently did they stop franchising and now flip back to corporate because the leverage they can get now on capital, their free cash flow can self-fund corporate stores. And I think if you look at McDonald's over time, McDonald's was, at one point in time, about 50% of their stores were corporate, and that came through free cash flow. So over time, do I see us adding some stores as brands, like specifically like a Heel that has, reached free cash flow? Will they evaluate more corporate stores? Yes, they will. They will do that, but as a percentage, it'll be a low percentage to the overall growth of the brand. So say if every 10 stores open, one was corporate, okay. That's very possible, but it'll be heavily weighted to the franchise side. Even if we were to acquire a brand that was all corporate today, we would still look at how to license it, how to franchise it, and probably have a two-pronged approach to growth, which is corporate stores as well as accelerated model through franchising.
So some big news recently. You are now CEO versus your chief investment officer title. So can you sort of explain a little bit about that? Why the change, and just unpack that for us.
Yeah, I think as as the company's evolved over time, we sort of gotten really good at playing our positions. And Sean, and his family being the largest shareholder, approached me recently with, the idea of thinking about what's best for the future and for him and his family and for the shareholders. And, said, hey, listen, I want you to be around long term. I believe I have a great position to play within the team, and, it could be a great partner to the business. And I think that's, we all treat each other like business partners more than anything. Said, listen, this is what I'd like you to do. And believe it or not, it wasn't something I grew up dreaming of doing. But based on how things have played out and the positions we play today, after some convincing, we decided to make that change. And, I'm excited. I wanted the opportunity to do right by, I think, Sean and his family and our shareholders. And I think today, how we've aligned this, kind of a funny one behind the scenes, but Sean's like, yeah, I'm your wags, for anybody that watches Billions, he is that guy that, I don't think there can be a successful organization in our business today without somebody like Sean. I've only ever seen one before in the business, and that was the unsung hero and the key piece to MTY, in my opinion, actually wasn't Stanley. It was Claude, his wife and the COO of the company. The lady was a machine. She was incredibly talented, able to touch every aspect of the business behind the scenes, allow Stanley to work on the business and the capital markets and the front-facing stuff. But who's got the nuts and bolts and took care of getting stuff done every day? That was actually Claude. And I think that's Sean on our team.
Well, that's good to hear. So Sean has moved over to sort of an operations role. You've moved into the chief executive officer role. I think it's a great move, and obviously you've been sort of the kind of face of the business for quite some time. So now it's official. Moving on, how much cash does the company have on hand right now? Cash and cash equivalent.
Cash and cash equivalents are about $4 million. So to your point, we're well funded, and we're able to be discipline with M&A opportunities. We're also able to deploy capital, as I mentioned, on organic, opening up new restaurant opportunities. We're active, very active on both those fronts, actually. So thankfully, we have the bank account and the balance sheet to do the deals that are in front of us today.
Are you profitable as a business today?
Both of our units are actually EBITDA positive. The business units are the CPG side and the QSR side, but the PubCo and the ParentCo side still has a minimal cash burn that we believe as we continue to accelerate the openings, which Q3 is a record for openings for us. Q4 I think will far surpass Q3. I think it's going to have a meaningful impact to our bottom line over the next 2 quarters. We just need to get the restaurants open and allow the royalties to continue to build.
How many, on that note, how many operational and corporate stores do you have? How many corporates are open?
We have 8 corporate restaurants today, and we have 24 franchise units now. So as of today, we're at 32 restaurants in operation, and with a significant amount in the pipeline, both under construction and with a total pipeline, I believe, of 376 stores to build.
Wow, phenomenal! So those have all been sort of financially committed for by different area managers, area development sort of agreements, and underlying franchisees.
That's right. So today, I believe, if you were to look today, I think we have another 15 that are at different stages of construction as we speak. So, if we're at 32 today, we have an M&A that's pending to close, which is 9 more stores. So it takes us to 51 plus the stores in construction. I think we'll achieve our goal, which was originally 35 to 40 restaurants is where we wanted to be for 2024. I'm very confident that we're going to exit 2024 under promising and over delivering.
That's pretty phenomenal because this is like real business. This isn't numbers on a page. This is like having to work with multiple different service providers, multiple different entities. It's not just the easiest thing in the world to go from trying to find a piece of real estate to actually getting an operating restaurant. 40 locations in a year, in 12 months. That's pretty phenomenal.
It is, and I say it sincerely. Like our team, as a team, and something I think we're just starting to get good at. I believe we're actually able to achieve more, but as we grow into it, right? There was no fake pressure or financial pressure to go out and make bad decisions, side bad real estate, force through franchisees that aren't qualified or anything like that. So it's something as simple that takes time, but Hamilton is an example as a municipality. Think about that city. They were hacked, and their systems were, and their permitting office was completely pushed back months. So that delayed us in a market that you would never expect it. So even something as simple as permitting, not every city is as friendly to work with as Calgary. Some of them take time, and they are moving their way through the development pipeline. For us to open another 10, 15 organic restaurants this year, to your point, when we started off not that long ago, we didn't even have 10 or 15. It is pretty meaningful. Like I said, for us, I think our goal this year was originally to get to 15 to 25 net restaurants, new open. And, we will far exceed that for the year. So now as we start to deliver on that, and we layer in the forecasted growth for next year, then I think 2025 becomes, a year where our base is, let's say, 50 restaurants, and we're building off that. That becomes very meaningful for us.
Excellent. So what's changed, since you're opening stores for Mucho Burrito? What's changed since then to now in the whole process?
What's changed? I would say financing is a process to the business as well for franchisees. So, making sure that, you can fulfill that pipeline. So, working with the TD banks, the RBCs, the Canadian Western Bank, that kind of stuff that allow your franchisees to continue to step up and execute on the opportunities. That's a big piece of the business. But I'd say marketing. Marketing is probably one of the things that changed the most in the business today. Where, before I think in most parts of of Canada, you could do a door hanger campaign or something simple that it was print. And today it's much your food and your programs are much more influenced by TikTok and social media and stuff that wasn't something that I grew up doing. So I think marketing is probably the piece. And if you look at what the team at Heal or the team at Rosie's has done, an incredible job, and it's had a very significant impact on their same store sales. So marketing is still, in my opinion, there's three P's: people, product, and process. We're very fortunate that we have the people. We have great products. Once you put it into the process and you market it well, like Rosie's has done, you can achieve some pretty incredible results. So I think marketing is probably the one that's changed the most.
Thanks for covering that. So there's been some discussion on U.S. expansion. The U.S. is always this sort of fairy tale fantasy land. It's 10 times the size of Canada in terms of population. It must be so easy to, open a business, but it is quite a bit different, and it's different currency, different processes. Obviously, different geographical sort of location. How's that process sort of going? Is there sort of like a specific sort of date of when we'd sort of see the first franchise or corporate store open in the U.S.?
Yeah, it's something I'm actively. Actually, one of the ladies that just called in when we're on this call is our broker in Florida. I'm down there in 2 weeks again with the team, looking at real estate, surveying the opportunities that we've found, and once we find one that we meet the criteria, we will move on it. It's obviously a lot more cap friendly and investor friendly for us to grow organically to start in the United States versus going down and making a large splashy acquisition like we watched some other guys do and then choke ourselves with debt. We're trying not to do that. We're trying to be debt friendly, do it with more bootstrapping it, boots on the ground and doing it that way. So I'll be down there again in 2 weeks, actively working with our franchisee and the real estate team. I probably speak to them now 2-3 times a week as we continue to evaluate the opportunities. It is something that's on our radar. Very aware when you see a company, example like Cava in the United States. I know that they're on the corporate side, but trading at 12, 13, $14 billion market cap, and they have 350 restaurants. I watch a company like Tropical Smoothie recently sold to BlackRock for 1,100 stores. Fetch a price of $2 billion. So, do we believe the opportunity is significant? Yes. Are we taking our time and just doing it one store at a time and being very disciplined? Yes, we are. We're not trying to blow up our balance sheet or do a silly deal just to get into the United States. We will enter the U.S. When the right opportunity is ready.
And there was some discussion before about maybe Heal would be sort of the first brand to maybe look at expanding into the U.S. Has that sort of thinking changed, or are you still thinking that way?
No, Heal is the first one we're working with on the United States side. We have an LOI in place for 10 stores in Florida. So my visit coming up is going to be Florida-based from Fort Lauderdale to Jupiter, Boca, all of that, that line is where you're going to see us spending our time. And that's the area of focus for us. It is a strong market as well for Tropical Smoothie and a few of the other players that are out there. But that is a market. We have had interest from the U.S. in Pyro, and we're just, slow playing it. We're just trying to get Pyro going here in Calgary shortly with our first franchise unit outside of the Founders Market. So that's the first step for us is to, get it going here in Canada. And then we would probably consider the U.S. at some point. But the opportunity today with Heal's just as of today opened their 11th store. I believe they'll be around exit the end of the year around 20. That brand is incredibly cash flow positive and growing. So it's at a different part of its life cycle. It was the first one that's ready to leave the nest and I think attempt the market in Florida.
Great. Now you've got I know that you've got CPG. We'll unpack that another time.
Yep.
I really just kind of wanted to focus on the QSR sort of opportunities. So maybe we could just kind of quickly go through each of the brands. You got Lettuce Love, you got Heel, you got Hero Grill, you got Rosie's Burgers, you got Joey Turks, Yolks, and then the one I can never pronounce, Via Chibo.
Via Chibo, you did it right. There you go.
If I'm not mistaken. Maybe you could just give us a quick run through on sort of each of the brands, and if I've forgotten one, my bad. But
yeah, no, absolutely. Yolks is let's start in the West Coast. A brand that I'm incredibly passionate about. The team and the people are excellent. We got the first franchise unit outside of BC under construction in Ottawa. I'm actively working on. We've got LOIs out for other ones in Quebec, Ontario, and Alberta, in Calgary primarily. So, Yolks is going to see some expansion here with restaurants starting to open in the next 3 to 6 months. I would expect several of them to be underway. So that brand is in motion. If you talk about Via Chibo, since we've closed on it, we haven't opened any units yet, but we are actively working with a few of our franchisees and our area developers to open subsequent stores. We're just in the process of that. So as soon as I can get the real estate confirmed and the franchisees done, we'd hope to execute on that and show growth as well in an asset that we just closed on, which is important to us to drive the EBITDA. If you look at Heel, as I mentioned, it's now store number 11. When we met them, they were at store number 2. It's on its way to store number 20. And I believe that's one of the brands that's likely going to be the first one to get into that magic sweet spot of somewhere between 50 and 100 stores. I can see that path forward for the brand to 50. And it gets to 50 to 100 stores. It's going to have a material impact on our business and our numbers, as well as our what I call the sum of the parts. When people start to understand the actual asset value that we have under each brand, I think Heel's going to recognize a lot of that here shortly in the next 24 to 36 months. But then you move forward, Lettuce Love, which was a brand we acquired with one. We currently have 2 more Lettuce Loves under construction, one in Bloor West in Toronto. That is, it's going to be ready, closer to the end of September. That's another one that permitting and process for construction was painfully slow.
Bloor West, I have no idea why it would take so long.
yeah, exactly. So, but it is in motion. And then we have another one in Westdale for Lettuce Love that's going to open right at McMaster University, right in the heart of the, one of the more prominent areas in all of Hamilton. So that's right at Mac and, right at the hospital, the gates of the hospital. So great space. Heel and Lettuce Love are both opening there. Same with Bloor West. It's a Heel and Lettuce Love. I'm actively working on multiple more stores that are going to be potentially combo stores, but with Lettuce Love. Some of the stores, as we move into Western Canada, you may see us, if we're looking for a protein option, we may look to partner Heel with Salus, or which is the new brand that we're in the process of closing on, because they are a protein option, not true plant-based. So that's in motion as well for Lettuce Love. We mentioned Pyro. Joey Turks just opened up its second store in Scarborough. Now we have franchisees that are committed to multiple more stores in that brand. So we've already initiated the real estate process to secure more real estate for Joey Turks. Touched on Via Chibo. Rosie's. Rosie's has been absolutely on fire, both from a same-store sales performance standpoint and from a growth standpoint. We have 2 stores, 2 more restaurants under construction in Calgary. We expect both of them to open in Q4.
Hey, how much is a burger at Rosie's Burgers?
Let's say most of them are between $8 and $12.
Well, McDonald's, the wife was wanting one of these new big arch things. $10. $10? My God.
Yeah.
That's crazy.
You know what?
Just for a sandwich.
I went up to a sandwich place the other day when I was in Vancouver, and the price was $19, and it was about an 8-inch sandwich. And I was like, pardon me, you know what I mean? $19? Like, I quickly put pencils down and, and looked at that one and said, yeah, we can't do this in business in this category like this. But yes, Rosie's has got 2 under construction, which takes it to 5 from where it is today. And then as well, Burlington is going to start construction here in Q4 and open. So Rosie's is another one that we did a deal with, and at 2 stores, it's shortly going to be, tripled in size at 6 stores. It has more stores on the way. I'm working them in the GTA, Ottawa, Vancouver. We have franchise interests, so we're actively working with Dustin and Daniel and the team at Rosie's on expansion right across Canada. So that brand is about to become very meaningful to our business at a revenue standpoint in Q4.
So a lot of restaurants out my way, they've gone from sort of a traditional burger to the smash burger. Is there any sort of like benefit from like a food cost point of view for like a smash burger versus more of a traditional sort of burger patty?
No.
Or is it really just a trend thing?
It's more of a trend thing, how it's cooked and the crust and how it's done, and it cooks quicker as well because it's a bit of a thinner product versus a big traditional. People say it used to be big, thick, juicy, and drip all over you kind of thing. What I mean? That used to be the in style, and yeah. So today I think it's more of on a thin style, and the type of bun they use and how they set it up. But Rosie's has stayed really true to the being about the classics, and and it like they want everyone to feel like it's that that cool neighborhood, like I'm at home type burger spot, and they've done a phenomenal job.
They have a chicken sandwich as well, do they not?
Yeah, they have a regular, which I like, but their spicy chicken sando, I'm a huge fan of. I believe it's the best chicken sandwich in Canada, and I didn't create it. That's all Daniel. Daniel's an incredible chef. Put that guy in the kitchen, and he can. The sauce on it is phenomenal. So he's an ex-Cactus Club guy, and has very good chops in the kitchen. So I love the brand. I'm very interested to see the attention it gets when it opens in Calgary shortly, as we expand it outside of GTA and even East GTA, which we're working on. I think that's gonna be a lot of fun. I think there's a huge open ice in the space today. The franchise demand from people within it, like one of the gentlemen that bought the one in Burlington, he's an ex Mucho Burrito person, and the guys out west are ex Mucho guys. So we're having a significant amount of our franchise interest coming from A&W, Mucho Burrito, like ex franchisees that we've worked with in the past. Even this morning, a former multi-unit Extreme Pita franchisee sent me over something. So we're very fortunate that we're going back to the well and working with guys that we've had a long history of success with.
Out of your different QSR brands, which would be the least expensive to kind of open?
Heel. Heel is the least expensive to open today, and it's one of the reasons why it's growing the quickest. I think as we start to open more Yolks and we open more Rosie's, you'll see that their same-store sales and their system sales become very significant, in our contribution for royalties and revenue. But Heel is the easiest to open because of permitting. It doesn't have venting, so that no venting and no deep frying. So landlords love it. And then also, it's got the lowest capex to open of any of the brands because of the small footprint. They can open in 300 to 800 square feet, so it requires very little capex compared to say Yolks. Yolks can cost 5 to 8 times the price to open versus a Heel.
What's the most seasonal brand? The one where you're going to have an ebb and a flow, depending on the season.
I'd say Heel, actually as well, because it's a it's a cold product, right? So I think we did notice it last year in Q3, Q4. Same store sales come off. You could see a 20 to 30% dip. In the wintertime versus summertime. But we're opening a significant amount of more stores. We're just in the process of initiating a national advertising fund and stuff like that we're going to be able to work with the franchisees on and collaborate and to build brand and build strategy. So that's a big part of 2025 as we start to get bigger. And, I think at some point too, you'll see us add to the team. I think we will continue to add on the operations side and the marketing side, seasoned, experienced people that we probably have a history with, and look to build on that and make sure we have the bench strength to support the kind of growth that we're delivering. It doesn't sound like a lot to say, okay, now when you reach 50 restaurants, but when you started at 1 not that long ago, getting to 50 is actually a ton of work. And if our goal is to get to 100, 200, 300, or open them all up that we have in the pipeline, which would get us to 400 or 500 restaurants, it becomes very meaningful. And so you need really good people. So we're in the process of that as well. One of the big things you will see us do is add bench strength.
Which of your QSR brands is least seasonal?
Least seasonal? I'd say today Pyro. Pyro is the strong year round. It's a really good brand, and I think that's same store sales are excellent. The unit economics are very good. I think that's probably why you're seeing the love affair in the United States with Cava. Because it is very strong at that. Rosie's doesn't have as big of a dip either. Some people do like to barbecue their own burgers in the summertime, but Rosie's is a very popular product year round. When I was with Christoph and the guys a couple weeks ago in Vancouver, and they're experiencing record numbers in the restaurants. So they're very happy to see where Yolks is going, and that's why I can't wait to see some more of them start to expand in Alberta, Ontario, and Quebec.
Excellent. So let's touch on the economy and sort of the consumer and restaurants and things like that. So some QSR stocks have just had unbelievable runs. You talked about it with Cava. The thing IPO'd at much less.
I think around $30.
14 billion. And it just has been an amazing performer. You got Sweet Greens, which has performed really well, which I know is one that you quite like. Chipotle's done well. Wingstop has done well. Even Shake Shack's performed pretty well over the last couple of years, and certainly year to date. But then we've also heard about the consumer starting to hurt, and the consumer's not eating out as much. So maybe you could talk a little bit about maybe how that sort of benefits you guys, or what people should sort of like look out for in terms of the sector and the economy.
Sure.
Can you give us a bit of
that's a great one, because I think if you look at the ones that I do focus on, Sweet Greens, Cava, Chipotle, and Wingstop, and Dutch Brothers, all of them are experiencing significant same-store sales. And twofold, I think, is happening here. I think people that are paying for that can afford it. They can still, their pockets haven't really been touched that much, because they're not looking for a $5 meal. They're looking for, a $15 meal or 20. So I think they're a little more insulated, the consumer that is buying and shopping at those places. I also think brands like Dutch Brothers, they're chipping away daily at the customer base of Starbucks. They are an agitator. They are actively taking market share on a store-by-store basis from somebody like Starbucks. I think if you look at Wingstop, incredible. They're double-digit same-store sales increases. They're great at social media. I think their product's okay. I don't ever say it was the best wing in my life, but I think they've done an incredible job at marketing. And their same-store sales, their stores are great. I spoke with the guys that own the rights to Canada. They're ecstatic. They're accelerating their growth in Canada with Wingstop. They're experiencing some incredible sales here in Canada. So I think it's more of a market share game. I think, Tim Hortons is losing customers. Yeah, McDonald's is losing customers to some of these guys. And same thing with Starbucks. There's a lot of good competitors that you can go out and get a great coffee and a great experience that over time, I think Starbucks lost some of that. They gave up the dining rooms. Some of them didn't even have seating in them anymore. And that used to be a place that people went to hang out. And, it was a cool spot to be seen and visit. And I would say over the last several years, that's been less of a focus of Starbucks. So innovation has done it too, though. If you look at one big thing for Starbucks, 75% of their beverages are cold today. Well, that's an unbelievable thing. Like when I saw it cross 50 a number of years ago, I thought that was crazy. Now 75% of their beverages are served cold. And what are we serving at Hue? Cold beverages. And why do you think our same-store sales and the brand's growing? Because the younger generation aren't all going and drinking hot coffees. They're getting alternative. They're getting bubble tea. They're getting smoothies. They're getting, cold beverage coffees, ice caps and stuff like that that's out there. So I think there's a big part of the market shift. I think the brands that are winning, Chipotle, as we mentioned, Cava, same-store sales are phenomenal. We are experiencing that as well. So do I think it's just because, I believe we're taking market share. I believe if we were in the same neighborhood as a Harvey's, a McDonald's, whatever, we're giving somebody an alternative. It's much more expensive, but it's an alternative. I think Dutch Brothers is doing it, and I believe they're taking shots at the big guys like Starbucks. Now, Starbucks made an amazing move and brought in a new CEO that has completely burned some people that were shorting them, and the biggest comp package I've ever seen in QSR, north of $100 million package to get the guy to leave Chipotle and come over to Starbucks. Great move, in my opinion. I think it's phenomenal, and I hope that we continue to buy and partner with the irreverent brands that'll go out there and steal market share. And one thing I don't think anybody yet appreciates about our platform that we're doing, if you look at the categories we're after, there's Kava, we have our answer with Pyro. I think if you were, when you see Pyro to that, when you see our answer to a Sweet Greens, we have that. We went and got one in Salas. We exactly across the board at those leading categories, we want to play in each one of them. Shake Shack's doing a great job. Their stock has done very well. We have our own version in Rosie. So the category leaders in the United States, we are literally building our own version and our own portfolio to make sure we have our own franchised model to those. Most of those either don't franchise or are owned by one single franchisee, that like the one in Canada that bought all of Shake Shack, or the one in Canada that bought all of Wingstop. Well, we'd like our own solution on the franchise side because we believe on a store-by-store, case-by-case basis, we can compete very well being the local favorite to the big national player. So that's exactly what we're doing in our emerging category, because every one of those ones that you mentioned and we've just talked about, those are all emerging brands. I think like the biggest mistake that McDonald's ever made was, they invested $300 and some million into Chipotle, and then the day of an IPO, they pulled out $1.5 billion. So they thought, hey, we did great. They got 5x their money. And I believe the other day when I read the report, those shares are now worth $80 billion that McDonald's sold for $1.5 billion. So it took time to build Chipotle, but they're a beast. The management team has proven that they can do some wonders as well with Kava. And, so I think emerging brands are really stealing market share more so than some brands are more sensitive to price. I think some customers that might shop daily at I'm going to say Tim Hortons, a Dunkin' Donuts, a McDonald's, some of them do shop there, year round because it's looking for value. Right. So,
sure. I was sort of reading that those are sort of most at risk for, the slowdown. They're the first sort of consumer, obviously, because they're price sensitive and only have so many dollars. So
that's right.
So those types of brands, and then obviously, fine dining is going to be fine dining, but also that sort of middle of the road full service dining has seen an impact where that business has kind of come over to QSR.
That's right.
So fast casuals down.
The dying down is a real thing. I hear guys saying it all the time. An executive said to me the other day, he goes, I was out in Calgary, and he goes, I found myself, instead of going to the keg one night, he goes, I walked in and I went to A&W, picked up food for the family. And he's like, wait a second, my job hasn't changed. Like, what am I doing at A&W? But just a mental thing. He dined down that night. So I do believe there will be brands that will benefit from it. I think, some of them twofold. Like some brands, their worst enemy is themselves. They open too many stores too quick, so they actually compete with themselves. So sometimes same-store sales for a brand is off because they've opened another one too close to the existing stores. So they've over-penetrated the market. And then I believe some of them get caught flat-footed. They didn't innovate. I think two of the brands that didn't innovate and got caught are in the sandwich category, I think, are Mr. Sub and Subway. I think if they would have innovated and pivoted back in 2013, 2014 early, Mr. Sub could be 1,000 stores today and growing. Instead, you have Subway grown obviously significantly in that time, but now you have Jersey Mike's, you have Firehouse Subs, and you have Jimmy John's coming in and competing and crushing these guys on their leases, their lease renewals. The market out there today is very competitive in the sandwich category. And when you get a franchisee as big as Redberry, in my opinion, I believe the largest franchisee in Canada, and for sure will be one of the largest in North America. They go on one swoop by 300 Jersey Mikes. Well, you don't want to be competing with them on real estate if you're Subway or if you're Mr. Sub, because they're the new kid in town. They got a great covenant, and Jersey Mike's is crushing it when it comes to same store sales. Firehouse is done quite well. So again, taking market share from Subway.
So an investor question, we've had a couple of
Yeah.
those, but another investor one, and you've mentioned their name quite a bit, Dutch Brothers. Is there some additional sort of white space, for you guys? Like Dutch Brothers is a bit more of a cold beverage drive-through sort of model. Is that sort of an area for some potential, new opportunity for a brand category that you might not sort of own? And what other categories are you sort of liking, if that's not the one?
I think coffee and beverages is a great category. I think the emerging categories today, the bubble tea, the brands in the U.S. like Swig, stuff like that selling ridiculous amounts of cold beverage. And I think that's, exactly what Dutch Brothers has done. Brands like Caribou Coffee, stuff like that. Seven Brothers. I guess the other one is the, Three Brew and stuff like that. Guys in the U.S. that are really coming up and clipping the heels of brands like Starbucks. So do I like the beverage category? Yes. Drive-through is really tough in Canada. Not many municipalities want to approve them. And if they do, you got to compete with the Popeyes, the Tim's, the Starbucks. Everybody has been out there. And, we've been very fortunate, and so have a lot of other brands. With Starbucks' big move to vacate non-drive-through locations, they've actually vacated and left open some AAA real estate across Canada, all because they wanted to move down the street and move into a drive-through. It has a pretty significant bump to their revenue, so I understand why they do it. But it's also much more CapEx intensive to do that. So we are not, at this point today, active with any of our brands in drive-thrus. We have experience in drive-thrus, but it's not really a focus from us. Beverage is a focus. I love the beverage category. I'd love to continue to expand, certainly Heal. And, we don't have a coffee brand today, but, we only have 8 brands today. So, one of the next big things for us, ideally, is we don't want to ever be a situation where we're 99 brands today. Like, I'm not trying to be the next MTY when it comes to that. We'd rather have own and dominate. I'd like to have 7,000 restaurants like they do, just not in 100 brands. We'd rather have 10, 15 brands that, as a floating average, that we go out and consolidate categories. So I'd rather have one brand that we have, let's say Rosie's. I'd rather go into another market and, buy out the local incumbent and, and convert them all to Rosie's. That would be a much more entertaining path forward for us, is to take one of our brands and go buy another one and consolidate, give us quick access to real estate, accelerate our growth. And if you look at who did that recently, Cava. Cava was only 50, 60 stores. They went and bought, I believe, Zoe's Kitchen with 300, let's say $1 million average unit volume. They converted them into Cavas. Cava has a $2.3 million average unit. So they got a huge lift. And they went from being a 60-store brand to being a 350-store brand overnight when they went and made an acquisition. So I think consolidating categories is something that I'd like to hear us talk about a lot more over the next 12 to 24 months.
So another investor question. You guys have been rather impressive in your ability to secure financing. You guys have not been doing underwritings. You guys have been doing overwritings, sort of above market financing, and also, interesting structures. So you're not, getting pounded 4 months later with shares hitting the market.
Yeah.
You've been able to get some very impressive investors in Paul Paletta and K2, which, aren't normally investing into microcaps of this size, probably because of the team that's sort of involved. And so with that prowess that you guys have in your ability to secure financing, is that an opportunity that you could, help provide to other sort of emerging brands that maybe it couldn't be an acquisition right now, but is that another way to deploy some capital and get a return, or is that just too much of a complication with all the moving parts you have going on right now?
Well, we're twofold. We're very fortunate that, yes, we've been able to get friendly capital in the door. I think some of them, including, in my opinion, they see the open ice opportunity with Recipe and, Fairfax and MTY. They also see the potential upside when we're trading at and the valuations that those guys got to. So then they back the management team, and they obviously had a belief that we can get there if we all work together. So that's the first part. Second part is we're very fortunate that franchisees do not need franchising financing from us. They have what's available to them across Canada, a small business loan, it's a government-backed loan. That's readily available to people. So far, almost every one of our franchisees have actually paid cash for their stores. They're experienced operators, they're well-funded. But on a go-forward basis, we do have some franchisees that are looking into the funding, and whether they go with a TD or an RBC or BDC, Business Development Bank Canada, there's opportunities for them to get funding. So we actually do not need to be in a position to fund franchisees. We don't even, at this point in time, have to consider funding any corporate stores. But we're also very fortunate. We have continuously, I'm getting inbound calls every month asking us to accept more capital. People looking to get in. And thankfully, we're in a position where we can say last funding was done at 75 cents. If you're looking for any funding less than that, then I recommend you buy in the float because we are fully capitalized for 2024. Have to be incredibly strategic for us to even consider it because at this time we don't need any of your capital. So, most microcaps don't say that, I think. And we're very fortunate that I can continuously decline additional capital that's being offered to us.
So you got a little bit of a wall of stock at 55 cents. As of right now, it looks like 454,000 shares on offer. It's been there for a little while. Any thought on that?
I was waiting for you to take it out, actually. You know what? It's been creating a buying opportunity. I had one of my good friends and former business partners sends me a note this morning, and then he calls me and goes, "Hey, I added another 100,000 shares last week." And I was like, "Oh, that was you?" And he's like, "Yeah, no pressure." And I was like, "Yeah, thanks, no pressure." But he didn't assume he'd be able to be buying, at 50 cents or less. So for the buyers, you love seeing it because it creates some artificial pressure and a buying opportunity. For the sellers, probably hate it. They probably want to trade it and see it go higher and move quicker. If you have the ability to be patient and you can afford to be patient in this business, I think we can make a lot of money by doing it right. And share price up or down today, 2 cents, whatever. Why it does yank on some people's emotions, it doesn't affect any business deal I'm working on. It doesn't. It's not something that I have to freak out about. I was just buying myself at 50 cents, and I was trying to buy more. I just didn't get filled on it all. So, would I like to be able to continue to see insiders buy when possible? Yes, I would. Do I appreciate the opportunity for some of our shareholders, like the one that called me this morning? He is a significant shareholder, and he added another 100,000 shares. So he's actually able to buy it cheaper and for the same amount of capital, buy more shares. So I don't know who it is that's put it up there. If they're being strategic to do it and buy underneath it, that's a pretty smart move too. Because I believe CIBC is posting the ask, and there's been a lot of CIBC buying underneath it. So I don't know. I don't know who it is. If they called us, would I help them try and get a cross trade? Yes, I would. But I haven't received a phone call on it. All I know, a few friends that are buying are like, "Hey, I don't know who that guy is, but can you thank him?" This is great.
Short-term catalysts. Let's sort of get into wrapping up here.
Sure.
I appreciate your time. You've given us an hour. So what are some short-term catalysts that we should expect to see over the next 6 months?
I'd like to see us close on our Salas M&A, which is, today one of our largest franchise units deals. It's an asset-light deal that we've announced, and we're working with legal. We're working on that this morning. So the next M&A to close, and I'd like to see us open the next 10 to 15 restaurants that are into construction, and I'd like to see us crush Q3 and Q4 numbers. Like Q3 and Q4 should be very meaningful as our royalty side continues to climb. So I still believe the most impactful thing we can do short term is deliver great fins. You know, I mean, there's nothing that's going to be better than our financials coming out and being great. So when I can see Gary smiling and you see your CFO very happy, that's probably a good time in our world. So I'd like to see that, and if possible, I'd like to execute more M&A. You know, I don't think we're done by any means. So what I'd like to do some more really disciplined, very accretive, cash flow positive, debt-free deals done. Yeah, I'm excited. Like I want more of those. So if I can get more M&A that checks those boxes, cash flow positive, debt-free, ideally, that'd be excellent. But I just want to buy them right and open a lot more restaurants. So get to the point where every one of our brands are showing growth. If we can do that in Q3, Q4, I think it'll be a great, finish.
Hey, excellent. Any final thoughts? Anything that we didn't cover you'd like to touch on?
No, I just think you don't care to put it out there. There's no bad bot deal coming that we're going to dump a bad financing on any of our shareholders' heads. We're very fortunate that we have funds and family offices that support us. I look forward to putting out our Q3 and Q4 numbers and showing the investors that took a leap of faith on us and took some risk, that we're slowly de-risking the investment and we're getting better at what we do. I'd like to see us close on our M&A, open more organic restaurants, be even more defensible as we enter 2025. So other than that, I hope to keep it very boring for all of you guys and just discipline growth every quarter so that we become predictable. And then people are okay buying us and at some point a lot higher than 50, 60 cents.
Okay, excellent. Well, Sean, congratulations on the new role, the CEO title.
Thank you.
It's going to look great on you. And thank you very much for your time here today. And I look forward to catching up with you again next quarter. And lots of good luck with getting those stores open.
Thank you very much. I look forward to the next update.